Hello, and welcome to episode 134 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I'm Odeta Kushi, Deputy Chief Economist at First American. Here with me today are Mark Fleming, Chief Economist at First American, and Xander Snyder, Senior Commercial Real Estate Economist. Hey, Mark, welcome, Xander.
Hi, Odeta. Hi, Xander. Since we are the three, econoteers today, I assume...
Clever.
Yeah, exactly right. I assume we're talking commercial.
That's right. It's great to be here again. And we are, in fact, talking about commercial today.
Well, we're not just talking commercial. Today, we're actually going back to the future. And yes, Mark, I see you smiling already.
I'm trying very hard to resist doing the obvious thing here. Huey Lewis, Eric Clapton. Should I keep going?
And I'm trying very, very hard to keep us from doing 15 minutes of movie references.
No doubt.
May I propose a compromise? We'll use the movie title once, and then we'll actually go on to talk about cap rates.
Fine. I promise we'll keep the movie references to a minimum. But joking really aside here, there is a serious point we're getting to. We've entered a new commercial real estate cycle, and the way cap rates behave this time around may look less like the last 25 years and more like an earlier period that many people in the industry haven't really lived through professionally.
Exactly. And this conversation builds on some recent work Xander's done looking at cap rate behavior across cycles. The core idea here is that even as the commercial real estate recovery strengthens, this next cycle may not deliver the same valuation tailwinds that people have come to expect through their own lived experiences.
That's right. And maybe we should start with why this historical comparison or the historical comparisons that we're going to make matter right now. We've talked elsewhere about 2026 is the year the commercial real estate cycle really takes hold. But this cycle is unlikely to resemble the last two expansions, the last two entire commercial real estate cycles that most professionals are experienced with, just largely because many weren't working in the 1990s or earlier.
Right, and things changed around the year 2000. Since 2000, cap rates have mostly trended downward, with only a brief interruption during the global financial crisis, or GFC. In other words, over roughly the past quarter century, the only two major commercial real estate cycles we've experienced were accompanied by meaningful cap rate declines. But that experience isn't necessarily a normal feature of commercial real estate expansions. It just happens to be the one most market participants are familiar with.
Right. When you extend the data further back, a more nuanced, complex picture appears. Over a longer time period, long stretches of sideways, uneven, or even rising cap rates are far more common than the sustained declines that we've seen in the last two cycles. So in that context, the last 25 years look more like the exception than the rule.
So today's episode is about resetting expectations, not forecasting outcomes, but understanding what type of cycle we may be in now and what history suggests about how cap rates have typically behaved in past cycles that possibly resemble today in at least some ways.
We'll take a step back here a little bit because we keep mentioning cap rates. So maybe a little bit of a refresher. Cap rates are a measure of yield on a commercial property. So it's simply the income they generate for their owner relative to the price of the property. More often than not, higher average transaction cap rates translate to lower property prices given a certain level of operating income. And lower cap rates translate to higher property prices. So cap rates consistently declining over the last two commercial real estate cycles provided a valuation tailwind. If cap rates move sideways this cycle rather than declining, that would eliminate the tailwind. We covered the mechanics of cap rates in a little bit more detail in episode 95 of REconomy, which we'll include in the show notes.
Right. So over the last 25 years, declining cap rates have provided a meaningful boost to commercial real estate investment returns. But as I mentioned a moment ago, historically, sustained cap rate declines have been somewhat rare. And if you look over this longer historical window, cap rates have spent decades at higher levels than what we've become accustomed to before the early 2000s.
I love our long historical windows because it gives a lot of insight. And what I'm hearing from this analysis is that extremely low cap rates observed around 2021 during the pandemic look more like an outlier when you take that longer historical perspective than a baseline for any future cycles. Great while it lasted, if you didn't buy at peak prices at least. but not something that we should be penciling in as the norm or an expectation that we will return to.
And that matters because when cap rates fall, valuation gains can mask a property's operational issues, things like higher than expected expenses, weaker leasing performance, or inefficient management that would matter much more if prices weren't being lifted by falling cap rates. When they don't, returns rely much more heavily on income and execution.
And that really is the key takeaway here. If cap rates don't decline persistently and meaningfully, then income growth and how efficiently those assets are operated accounts for a larger share of total returns. Given where cap rates stand today, by historical standards, which is very low, this cycle is less likely to be characterized by broad sustained cap rate declines. Now, after multi-decade cap rate declines, both cap rates and interest rates today are relatively low, and the supply of commercial real estate mortgage debt in the economy is quite high, but declining. Cap rates should move mostly sideways because higher for longer financing costs and tighter debt availability will put upward pressure on them, while improving demand and fundamentals will push them down somewhat, leaving a rough balance and hence the sideways trend that we're talking about here.
Okay, so if anyone really wants to go a layer deeper, we've put together a companion piece on the First American Economic Center that lays out the long-term cap rate and interest rate trends visually. It's a helpful way to see the historical patterns we're talking about here. For those watching the video version of the podcast, here it is. But if you're listening, we will have links in the show notes, or you can watch the video version. So, Xander, you mentioned the 1990s earlier and how many of today's CRE professionals aren't old enough to have been working in the 1990s. And for the record, I'd like to point out I'm the only econoteer here on this podcast that was actually in the workforce in the 1990s. It was an okay decade, although not nearly as good as...
Yeah, we know the 1980s were very predictable.
Exactly. Xander, to you.
What I think makes the 1990s a useful comparison to today is what led up to the early 1990s recession. So the savings and loan crisis, which drove that recession, followed an inflation-driven interest rate shock that exposed a number of underwriting weaknesses, which meant that loans were being made based on overly optimistic assumptions about income and values. And this led to strained financial institutions. Again, similar in structure today, although clearly there are some differences if we were to get into the detail of that. After that recession in the early 1990s ended, cap rates didn't fall steadily. They moved unevenly and largely sideways throughout most of the rest of the expansionary period, or the rest of the 1990s, until the next recession.
And going back to that definition that Odeta stated earlier in the episode, that means that returns during the period were driven far more by income growth than any valuation increases. Less magic earnings from prices going up, more from hard work in improving operations and growing the top side.
That's right. And the point here isn't that history will repeat itself exactly, but that the mechanics of that period may be more informative than the post-2000 experience to today. And most of us don't have direct experience operating in that kind of an environment. We conducted a poll on a recent webinar that I hosted and found that a majority of the audience, roughly 60%, entered the commercial real estate industry in the 2000s or later. So that means that 60% of all people on that call only knew declining cap rates.
That's actually really interesting, and that you asked that. Okay, so we've talked a bit about long-term cap rate trends, but what about interest rates? Interest rates get a ton of attention in commercial real estate discussions, and for good reason. But historically, there are limits to how much they explain cap rate movements.
Exactly. So over the long run, changes in interest rate explain only about a quarter of cap rate movements. The relationship is statistically meaningful, but it's just not especially strong. So if you check out the First American Economics blog, this companion post that we're talking about has a chart showing this relationship between cap rate movements and interest rate movements over time. And we'll have a link to this in the show notes.
And for the video watchers, cue the chart. And in some periods, the relationship breaks down entirely, with interest rates moving one way while cap rates move the other. And this really underscores that most cap rate movement is driven by forces beyond interest rates alone.
Which brings us to another important takeaway. Historically, the availability of credit has mattered more than the price of credit.
Right. Commercial real estate is a credit intensive asset class, meaning most commercial property purchases rely heavily on borrowed money rather than all cash transactions. So when commercial mortgage credit is readily available, transaction activity tends to increase and cap rates tend to fall. When credit tightens, activity slows and cap rates tend to rise, even if interest rates themselves are relatively stable.
And of course, it's also worth noting that the post-global financial crisis period was unusual in terms of the decade-long sluggish broad economic growth despite historically low interest rates. The most recent shouldn't be treated as the norm.
All right, that's another point in the this cycle is the exception, not the rule bucket. I think that makes us exceptional. But all right,
I like
moving
it.
right along. Another important point worth highlighting that we've already referenced throughout the episode is about experience, or in many cases, the lack of it.
Right. Most commercial real estate professionals entered the industry during a period dominated by declining cap rates, long persistent declining cap rates. And that shapes intuition. It shapes expectations, often subconsciously, but that shapes assumptions.
Which means many people have limited lived experience. That's a tricky one. Operating in environments where cap rates move sideways or rise for extended periods. And yes, maybe it's wise to listen to that colleague with all the lived experience who likes decades like the...
Oh my goodness, we get it, the 1980s. All right, well, that dynamic may make the adjustment to the news cycle a little more challenging, even if the underlying economics are sound.
Right. If cap rate compression has always been part of the return story, then losing that valuation tailwind requires a meaningful adjustment in how returns are achieved and evaluated.
So this new commercial real estate cycle is already underway, but it may look more like the 1990s than anything that we've seen in the last 25 years.
Indeed, cap rates are unlikely to fall substantially throughout this cycle, which matters because cap rates are one of the main ways investors translate income into property values. Some segments may see declines, right? There are various asset classes within commercial real estate, particularly where fundamentals improve, but broad valuation tailwinds appear limited at this time.
Exactly. And that shifts the focus toward income growth and operational execution as the primary drivers of return in this cycle.
And the broader lesson really about expectations. History suggests that sideways or uneven cap rate movement is far more common than persistent declines, even if that's not the version of history most of us have lived throughout our careers.
Right. So that means that both the challenge and the opportunity in this cycle is earning returns the good old fashioned way through operational efficiency, through growing income, discipline, and rolling up your sleeves and executing like a professional.
Ooh, I got an idea. Translation. Show up, do the reps. Wax on, wax off, wax on, wax off. No.
In this cycle, cash flow rules everything around the deal.
Hey, was that just a Karate Kid reference followed by a Wu-Tang song reference?
Wait. What? There was
Wu-Tang
another
Clan?
reference beside mine? I completely missed the Wu-Tang song reference.
Subtlety is my strong suit, and we are in a heated 80s versus 90s reference battle at the moment, and so I wanted to make sure I got the last word there.
Win the battle, yet to win the war.
True, but there's a long year ahead of us.
So true.
And on that note, thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can subscribe to our Econ Center at firstam.com/economics or connect with us on LinkedIn. Until next time.
Thank you for listening. You can find even more economic content at firstam.com/economics. This episode is copyright 2025 by First American Financial Corporation. All rights reserved.